Welcome to the deep dive. You've seen the headlines, heard the analysts, maybe even dabbled yourself. The stock market, it feels like this omnipresent force, right?
Right.
Constantly shifting, often dictating the financial pulse of the world.
It really does.
But beyond the ticker symbols and, the daily ups and downs, what are the fundamental currents actually driving this massive engine?
Exactly. And it's easy to get caught up in the noise,
Yeah.
the day-to-day chatter. But our mission today is to, well, cut through that.
Okay.
We've taken your sources, really distilled them, and we're ready to guide you on a deep dive into the stock market. We want to move beyond just the definitions
Right.
to reveal the underlying mechanisms, the surprising historical threads, and maybe most importantly, why it fundamentally impacts your life, even if you're not actively trading yourself.
So we're going to unpack not just what stocks are, but the sort of genius behind fractional ownership itself.
Yeah.
We'll explore the intricate dance between primary and secondary markets, delve into the subtle art of price discovery, and meet the diverse players who make this whole system hum. Then we'll dive into how market dynamics truly work, from the psychology of bubbles to the power of indexes.
Right.
And finally, look at how you can maybe approach this landscape with a bit more confidence.
Sounds like a plan. Let's start with the cornerstone then. A stock. I mean, most people know it's a piece of a company.
Sure.
But what's truly insightful here isn't just the definition. It's the implication of that fractional ownership.
Okay, tell me more.
It's a company's way of raising capital for growth, for innovation, maybe expansion, without taking on the burden of debt. It essentially allows the crowd, the public, to fund ambitious ventures.
That's a critical point. It kind of democratizes ownership in a way and aligns your interests as an owner with the company's success.
Precisely.
And when we talk about the stock market, we're actually talking about this huge interconnected ecosystem. It's this broad network where all this buying and selling happens.
Right. It's the general concept. And then within that ecosystem, you have specific stock exchanges.
Like the NYSE or NASDAQ.
Exactly. Think of places like the New York Stock Exchange or NASDAQ. These are the organized venues, the literal or virtual town squares where trades are executed
Okay.
and where orderly markets are maintained. They provide the infrastructure that turns that fractional ownership into a fluid asset you can trade.
It's incredible to think how far we've come. I mean, this modern system actually traces its lineage way back.
Oh, yeah.
Back to the 12th century French courtier de change. They were basically managing agricultural debts.
Right. Early forms of brokerage.
Then you had 13th century Venetian bankers trading government securities. It seems it's always been about organizing capital somehow.
Absolutely. And what's fascinating is how these early kind of informal systems gradually came together, became more organized. The Amsterdam Stock Exchange, established in 1602,
That's the big one historically.
it is widely considered the world's first formal stock market. It really set the precedent for organized trading as we sort of know it.
And for us in the U.S., things kicked off with the Philadelphia Stock Exchange in 1790, followed swiftly by the New York Stock Exchange in 1792, born from that famous Buttonwood Agreement.
Ah, yes, the tree.
Literally, a group of brokers gathering under a buttonwood tree to agree on trading rules. Pretty amazing start.
And then came a true game changer. NASDAQ in 1971. This wasn't just another exchange. It was the first electronic stock market.
Huge deal.
Totally revolutionized speed, accessibility, paved the way for the digital trading we see everywhere today. It really changed the playing field.
So we understand the basic idea and history,
Yeah.
but how does this grand ballet, this market, actually work day to day? It seems to revolve around two key stages, the primary and secondary markets.
That's right.
What's the fundamental difference between them for someone, maybe thinking about investing?
Okay, so the primary market is where a company first goes public. Think of it as the launch pad.
Right.
This typically happens through an initial public offering, an IPO. That's where a company issues new shares and sells them directly to investors to raise that initial chunk of capital.
So that's the moment a private company brings in public investors.
Exactly. And once those shares are out there, out in the wild, they migrate to the secondary market.
Okay.
This is where the vast majority of daily trading occurs. You, the investor, are buying and selling existing shares from other investors on an exchange.
Not directly from the company anymore.
Correct. The company doesn't see a dime from these subsequent transactions, usually,
Mm-hmm.
but it's where their valuation is constantly being assessed, constantly fluctuating.
And that fluctuation is driven by, what we call price discovery.
Precisely, which is fundamentally about supply and demand. Simple concept, complex reality.
How so?
Well, if more people want to buy a specific stock, then there are people willing to sell it at current prices.
Mhm.
The price goes up. Conversely, if there are more sellers than buyers, the price falls. It's this continuous collective assessment of a company's worth based on all available information, sentiment, everything.
And a key indicator within that process is the bid-ask spread, right?
Yes, exactly. That's the difference between the highest price a buyer is willing to pay the bid and the lowest price a seller is willing to accept the ask.
And what does that tell us?
A narrow spread often signals a very liquid stock. Lots of buyers and sellers, easy to trade quickly without moving the price too much. A wider spread might mean less liquidity.
Got it. Historically, this collective action, this price discovery, happened on physical trading floors through open outcry systems.
Yeah, traders shouting, using hand signals, pictures of controlled chaos, basically.
Chaotic but dramatic. Today, though, it's predominantly electronic trading systems like NASDAQ.
Right, which have turbocharged speed and efficiency, make global markets more interconnected than ever.
Though some hybrid systems still exist, like the NYSE.
Correct. The NYSE, for instance, combines electronic orders with a physical trading floor for certain types of transactions. Keeps some of that human element involved.
Okay. Now, to truly grasp the market, you also need to understand its key players. Who's involved in all this?
Well, you have individual or retail investors, like many of us listening, and then the colossal institutional investors,
The big guys.
the big guys. Mutual funds, pension funds, hedge funds, insurance companies. They manage vast sums of money and can really move markets.
Then you have more specialized roles, traders.
Yep, those who buy and sell over much shorter time horizons, looking for quick profits. Then there are market makers.
What do?
They provide essential liquidity. They stand ready to buy and sell a particular stock, ensuring there's always a counterparty for trades. They make money on that bid-ask spread we mentioned.
Ah, okay. And brokers.
Brokers are the intermediaries. They facilitate your trades with the market, whether it's an online platform or a person you call.
Crucially, though, all these moving parts are overseen by regulators.
Absolutely vital, like the U.S. Securities and Exchange Commission, the SEC, and FINRA. Their role extends beyond just policing.
It's about trust.
It's fundamentally about maintaining trust in the system, protecting investors, fostering fair and transparent markets, and ensuring public companies stick to strict disclosure requirements. You need that for it to function.
So, given all this complexity, the history, the players, why does any of this matter to you, the listener, even if you've never bought a single share yourself?
Oh, it absolutely does. The stock market plays a profound, often unseen role in daily life.
How so?
Well, first, it's the primary engine for capital formation and economic growth. Think about it. Companies use the market to raise the funds they need.
For R&D, expansion?
Exactly. Research development, building new factories, hiring people. Ultimately, job creation. This isn't just about corporate balance sheets. It's about powering the innovation that shapes our world.
And it acts as a pretty efficient mechanism for allocating those resources, doesn't it?
In theory, yes. Investor decisions, buying and selling, effectively signal which companies are perceived as most promising. It directs capital towards those ventures that society collectively believes will generate the most value.
Okay, that's the big picture. What about on a more personal level?
Well, it's perhaps most tangible for the individual is its role in wealth creation and financial security. The market provides opportunities for both individuals and institutions to grow wealth,
Through capital gains,
selling shares for more than you paid, and through dividends.
which are a share of the company's profits.
Right, if the company chooses to pay them out, it's a way to participate in the success of businesses.
And many of us are already in the market, maybe without even realizing it.
That's a key point. Your 401k,
Oh.
your pension plan, maybe college savings accounts, or even some health savings accounts.
They're often invested in stock.
Very often, yes. Indirectly, perhaps through funds. But your long-term financial goals, especially retirement, are directly tied to the market's performance. It's woven into the fabric of modern financial planning.
And connecting this back to the bigger picture, the stock market also acts as a kind of economic barometer.
A vital one, yes.
Yeah.
Major market indices like the S&P 500 or the Dow Jones Industrial Average, they aren't just arbitrary numbers.
It means something.
They're real-time snapshots of overall market performance and, by extension, you could argue, broader economic health, or at least sentiment. Rising prices often signal investor confidence.
Things are looking good.
Right. While falling prices can indicate widespread concerns about the future.
And people pay attention to this.
Absolutely. policymakers, businesses, individuals. We all scrutinize these indicators to inform strategies and decisions. It's not just a reflection of the economy. It's a living, breathing feedback loop for the entire economy.
Okay, so it clearly matters. Now, let's explore what makes those prices actually fluctuate, the market dynamics, the ups, the downs, and what's driving them.
It's a constant interplay, really. On one hand, you have company-specific
Like
news.
earnings reports.
Exactly. Stellar earnings reports, a groundbreaking product launch, maybe a major leadership change, or even, a scandal. These can send a stock price rocketing or plummeting almost overnight.
But it's not just about individual companies, is it?
Not at all. Macroeconomic indicators exert massive influence across the board.
Things like interest rates.
Interest rates, inflation, GDP growth figures, unemployment rates. These broader economic trends impact investor sentiment everywhere. They influence how much risk people are willing to take on, which affects everything.
And of course, global events. We see this all the time.
Constantly. Wars, international trade policies shifting, geopolitical tensions flaring up, even natural disasters. These can send shockwaves that affect stock prices worldwide, often in unpredictable ways.
It's truly a global ecosystem now. Information, and maybe more importantly, sentiment, travels at light speed.
It really does. And this constant flux, all these inputs, give rise to what we call volatility.
Which means rapid, unpredictable price changes.
Exactly. It's often viewed negatively as risk. But volatility also presents opportunities for those who can navigate it effectively.
And we've certainly seen historic examples of things getting, well, out of whack. Price bubbles.
Oh yeah, like the dot-com bubble back in the late 1990s?
Yeah.
Prices surged way beyond any rational measure of intrinsic value, just driven by speculative fervor, FOMO.
Fear of missing out.
Right. And when that speculative buying runs out of steam, those bubbles can burst spectacularly, leading to market crashes.
Sudden, severe drops, often triggered by panic selling.
Think of the 2008 financial crisis, or that sharp but actually quite brief crash we saw in early 2020 with COVID-19.
Scary times. But what's insightful here, looking back, is the market's historical resilience, right?
Absolutely. Despite their dramatic impact, bubbles burst, crashes happen, but historically they've resolved over time. Markets eventually find a new equilibrium and generally resume their upward trajectory long term.
And there are mechanisms now to manage extreme drops, circuit breakers.
Yes, significantly. Since major shocks like Black Monday in 1987, circuit breakers have been implemented. These are automatic trading halts.
They just pause everything.
For a short period, yes. During extreme market plunges. The idea is to give investors a moment to breathe, to process information, and hopefully prevent panic selling from spiraling completely out of control.
Okay. Speaking of trends, you've certainly heard the terms bull market and bear market. Can we clarify those?
Sure. A bull market is simply a period characterized by generally rising stock prices and widespread investor optimism. Confidence is high.
Things are charging ahead.
Exactly. And these tend to last much longer, historically. Conversely, a bear market is a period of generally falling stock prices, usually defined as a drop of 20% or more from recent highs.
Driven by pessimism.
Pessimism, fear, sustained selling. These trends can be self-reinforcing for a while, but again, historically, bull markets tend to outlast bear markets. It reflects that underlying long-term economic growth is the more powerful prevailing trend.
And to track these broad movements, we rely on stock market indexes, like the Dow.
The Dow Jones Industrial Average, or DJIA, yeah, it's probably the most famous one. It's a price-weighted index of 30 large American corporations.
Maybe not the whole picture.
Well, it's influential, but because it's price-weighted and only 30 stocks, the S&P 500 is often considered a more comprehensive and useful indicator by professionals.
Why is that?
It's market capitalization weighted, meaning larger companies have a bigger impact, and it includes the 500 largest U.S. companies. So it reflects a much broader slice of the U.S. economy.
And NASDAQ.
The NASDAQ composite tracks all stocks listed on the NASDAQ exchange. Because of NASDAQ's history, it tends to have a higher proportion of technology and growth-oriented companies.
And of course, these aren't just U.S. things, they're global indices too.
Oh, absolutely. You have major indices worldwide, the FTSE 100 in the UK, the Nikkei 225 in Japan, the DAX in Germany, the CSI 300 in China, the TSX Composite in Canada, many others.
Yeah, and their main purpose is benchmarking.
Exactly. They serve as vital benchmarks, not just for tracking overall market performance, but also for measuring how well your own portfolio is doing compared to the broader market.
Okay, so now that we've peeled back the layers of how the market works, the dynamics, let's explore the options for actually investing in it. How can you potentially grow your wealth this way?
Fundamentally, you make money in two primary ways:
Okay.
capital gains and dividends. Capital gains are pretty straightforward. It's the profit you realize when you sell shares for more than you originally paid for them. Buy low, sell high.
The classic goal. And dividends.
Dividends are different. They're a portion of the company's profits that are paid out directly to shareholders, usually quarterly.
Hmm.
Not all companies pay them, though.
Why not?
Some, especially younger, high-growth companies, prefer to reinvest all their profits back into the business to fuel further growth, hoping to deliver higher capital gains down the line.
Makes sense. Now, when it comes to the types of stocks, you often hear about common versus preferred stock. What's the deal there?
Good question. Common stock is what most people mean when they talk about stocks. It typically carries voting rights, so you get a say in electing directors, major corporate decisions, and offers the potential for greater capital appreciation and those variable dividends.
And preferred stock.
Preferred stock is a bit different. It usually offers fixed dividends, which are paid out before any dividends to common shareholders. They also have priority in liquidation if a company goes bankrupt.
Sounds safer.
Generally less volatile, but the trade-off is typically no voting rights and often less potential for big capital gains compared to common stock. It's a different risk-reward profile.
Stocks are also categorized by their market capitalization, right?
Yeah.
Large cap, mid cap, small caps.
Exactly. Market cap is just the total value of all a company's outstanding shares. Roughly speaking, large cap companies are those giants worth over, say, $10 billion.
Like Apple or Microsoft.
Right. Mid caps are typically between $2 billion and $10 billion, and small cap are maybe $250 million up to $2 billion. These size categories often give you clues about their growth potential and volatility. Smaller companies can grow faster, but might be riskier.
Another really insightful way to categorize stocks is by sector.
Yes, using something like the Global Industry Classification Standard, or GICS, it organizes companies into 11 broad sectors:
Like energy, technology, healthcare.
financials, consumer staples, utilities, etc. This framework is incredibly useful for building a diversified portfolio.
How so?
Well, different sectors perform differently depending on the economic cycle. Tech might boom when the economy's strong, while utilities or consumer staples might hold up better during a downturn. They're considered more defensive, so you can diversify based on your risk tolerance and outlook.
Okay, so lots of ways to think about stocks. What about the actual strategies people use? There seem to be so many philosophies.
There are quite a few. What's truly fascinating here are the various approaches. A very common one is buy and hold.
Just buy good companies and wait.
Pretty much, it's a passive, long-term approach, banking on the market's historical upward trend over decades. Requires patience and discipline, ignoring the short-term noise.
Then there's growth investing.
Right. That focuses specifically on companies expected to grow earnings at an above-average rate compared to their industry or the overall market. These are often those companies reinvesting profits rather than paying big dividends.
And the opposite, almost, is value investing.
Kind of. Value investing, famously championed by figures like Warren Buffett, is about actively seeking out stocks that you believe the market has undervalued. Stocks trading for less than their perceived intrinsic worth. Looking for bargains.
What about people who need income now?
That leads to income investing. This strategy emphasizes stocks that pay consistent, reliable dividends, often with a history of increasing those payouts over time. The goal is generating a steady stream of income.
And then there's momentum investing. That sounds dynamic.
It is. It's a more tactical and generally riskier approach. It focuses on riding existing market trends, buying stocks that are already rising strongly, and selling them when they appear to be losing steam. It's about capturing short to medium-term movements.
So lots of options. When you're actually ready to dive in, how do you physically get started? You need a broker, right?
Yes, the broker is the firm that acts as the intermediary between you and the stock exchange or market. You need one to place trades.
And there are different types.
Quite a few choices now. You have traditional full-service brokers. They offer comprehensive financial advice, planning, wealth management, the whole package, but usually with higher fees. Good if you want a lot of guidance.
What if you want to do it yourself more?
Then you might look at discount brokers. They provide the basic trading services, often some research tools, but with much lower fees. They're suitable for more self-directed investors who make their own decisions.
And online brokers, seems like everyone uses those now.
They've really democratized access, haven't they? Online brokers offer convenient web-based or app-based platforms, often very cost-effective. Many even offer commission-free trading on stocks now. Great tools for self-directed investors.
Then there are robo-advisors.
Yep, a newer category. Robo-advisors use algorithms to build and manage a diversified portfolio for you based on your goals and risk tolerance. It's very hands-off, typically low fee, perfect for those who want a set-it-and-forget-it approach.
And I think some companies even let you buy directly from them.
That's right, direct stock purchase plans, or DSPPs. Some large companies offer these, allowing you to buy shares straight from the company itself, sometimes bypassing traditional brokerage fees, especially good for smaller, regular investments in a specific company you like.
Okay, so you've picked a broker, maybe bought some stocks. This raises an absolute crucial point: managing risk.
Couldn't agree more. And the number one tool for that is diversification.
Don't put all your eggs in one basket.
Exactly. It's about spreading your investments across various asset classes. Not just stocks, but maybe bonds, real estate too, and within stocks, across different industries and geographic regions.
Why is that so important?
It reduces the impact if any single investment performs poorly. If your tech stocks take a hit, maybe your healthcare stocks or international stocks hold up better, smoothing out your overall returns.
And how do most people achieve diversification easily?
Through funds, actively managed mutual funds, where a manager picks stocks, or, increasingly popular, exchange-traded funds, ETFs.
How do ETFs work?
They trade on exchanges just like stocks, but they typically hold a whole basket of underlying assets, often tracking a specific index, like the S&P 500, or a sector, or a region. Index funds, whether mutual funds or ETFs, just aim to mirror a specific market index performance. They're a very efficient way to get broad diversification instantly.
So it's about balancing your stock investments with other things too.
Ideally, yes. Balancing stocks with potentially less volatile assets like bonds, or maybe even real estate, depending on your overall financial picture and goals.
Now, while the market offers incredible opportunities, it's easy to make mistakes, right? What are some common pitfalls?
Oh, definitely. There are common behavioral mistakes that often trip up investors, even experienced ones. Trading too often is a big one.
Trying to time the market.
Exactly. Constantly buying and selling can rack up transaction costs, taxes, and often leads to worse results than just sticking with a long-term plan. Patience usually pays off.
Another big one seems to be emotional investing.
Huge. Making decisions based on excitement when things are booming or panic when they're crashing, rather than sticking to your well-defined long-term goals and strategy. Keeping a cool head in hot moments is probably the biggest challenge for many investors.
And related to that, maybe reckless investments, chasing huge returns.
Yeah, getting lured into overly high-risk securities or strategies without fully understanding them can lead to significant, sometimes devastating, losses. And critically, selling during a market crash.
Locking in those losses.
Precisely. Instead of potentially holding on for the recovery, which, as we said, history shows often happens eventually. And finally, a word of caution about margin trading.
Borrowing money to invest.
Yes, it involves borrowing money from your broker to buy more securities than you could with your own cash. It can magnify gains exponentially if you're right.
But also losses.
Also losses, equally exponentially. It's a powerful tool, but extremely risky, and really only suitable for sophisticated investors who fully understand the potential downsides.
Okay, so the stock market is clearly a huge part of the financial landscape, but it's not the only asset market out there, is it?
Not at all. It's good to have perspective. Briefly, we also have bond markets.
What happens there?
Bond markets involve buying and selling debt securities. Essentially, you're lending money to corporations or governments in exchange for regular interest payments and getting your principal back later. They're generally considered safer than stocks, offering more stable, predictable returns.
There are also real estate markets, of course.
Right, offering potential for price appreciation and rental income. You can invest through direct property ownership, which is a big commitment, or through real estate investment trusts, REITs.
What are REITs?
They're companies that own, operate, or finance income-generating real estate. You can buy shares in REITs on stock exchanges, giving you exposure to real estate without having to be a landlord.
Then you have commodities markets.
Yep, where raw materials are traded. Things like gold, silver, oil, natural gas, agricultural products like wheat or corn. Trading happens either for immediate delivery, the spot market, or through futures contracts for delivery later, often driven by global supply and demand dynamics.
And the foreign exchange market, Forex.
The Forex market. That's the largest financial market in the world, by far. It involves the trading of currencies, betting on the fluctuations in exchange rates between pairs like the euro and the US dollar, or the yen and the pound. It's incredibly complex and operates 24 hours a day.
And finally, the new kid on the block, crypto.
Right. The cryptocurrency market. Trading digital currencies like Bitcoin, Ethereum, and thousands of others, it's a newer space known for being highly volatile.
Huge potential gains, but also losses.
Exactly. And sometimes these crypto assets, certain tokens, even include governance rights, allowing holders to vote on the future direction of decentralized autonomous organizations, or DAOs. It's a rapidly evolving area.
So after this really comprehensive deep dive, what does it all mean? Where do we land?
Well, I think it's clear the stock market is far more than just a place to, buy and sell pieces of companies.
It's fundamental.
It's a fundamental, incredibly dynamic part of the global economy. It provides crucial capital for companies to innovate and grow.
Which fuels the economy.
Right. And it offers significant opportunities for wealth creation for you, the individual investor, over the long term.
It's an intricate dance, isn't it? Economics, technology, definitely human psychology, all constantly evolving.
Absolutely.
So here's a final thought to leave you with. Considering that the average annual growth of the S&P 500 has been about, 10.5% since the 1920s? Which is amazing long term, but individual years can swing wildly, as we know. What does this long-term resilience, coupled with those historical crashes and bubbles we talked about, tell you about maybe the fundamental human desire for growth and the inevitable role of emotion, even in these sophisticated financial systems?
That's a fascinating question to ponder. It's certainly a powerful testament to both forces, isn't it? Human ambition and human emotion driving things forward, even through the turbulence.